Welcome to Tax Smarts Unlocked, the podcast for individuals and small business owners looking to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode is packed with insightful advice on proactive tax planning to help you navigate the complexities of tax laws. Here's your host, David Robson.
Welcome to Tax Smarts Unlocked. I'm David Robson, your resident tax strategist, here to help gig workers keep more of what they earn. Today we're tackling the maze of gig economy taxes, practical moves you can make now to lower taxes, manage cash flow, and stay audit ready. If you drive, deliver, design, code, film, or sell online, this episode is your roadmap. Grab a coffee, open your notes, and let's start saving you real money. First, who counts as a gig worker? Think freelancers, rideshare and delivery drivers, content creators, consultants, tutors, and platform sellers on sites like Etsy, eBay, Poshmark, or Amazon. For tax purposes, you're typically a sole proprietor engaged in a trade or business. That matters because profits are taxable and losses are deductible, unless the IRS classifies you as a hobby. Show a profit motive, keep records, market your work, and price to avoid hobby loss treatment. How does your income get reported? Most gig workers file Schedule C to report business income and expenses, and Schedule SE to calculate self-employment tax. Watch for Forms 1099 NEC for services and 1099K from payment platforms. Thresholds for 1099K are in flux, so do not rely on them. Report all income. Keep your own ledger of payouts, tips, cash, and platform fees. Reconcile deposits to statements so you can prove totals if a notice arrives. Let's demystify self-employment tax. It's 15.3% on net profit, 12.4% for Social Security up to the annual wage base, and 2.9% for Medicare with no cap. High earners may owe an extra 0.9% additional Medicare tax. You also pay income tax on the profit, but you get an above-the-line deduction for half of your self-employment tax. Translation: track expenses aggressively and accurately. Every dollar of legitimate deduction avoids both income and self-employment tax, everywhere you can. Because no employer withholds for you, you'll likely need quarterly estimated payments. Federal deadlines usually hit April 15th, June 15th, September 15th, and January 15th. Use safe harbor rules to avoid penalties. Pay in at least 90% of current year tax or 100% of last year's, 110%, if your prior year AGI exceeded certain thresholds. A simple system: set aside 25% to 35% of net profit weekly into a tax savings account and automate quarterly payments. Set reminders religiously. Entity choice can change your tax and legal picture. A sole proprietorship is default and simple. An LLC doesn't change federal tax by itself, but can provide legal protection and credibility. Once profit is consistent, consider electing S corporation status to potentially reduce self-employment tax by splitting profit into reasonable W-2 wages plus distributions. Trade-offs include payroll costs, strict compensation rules, state taxes, and extra filings. Run the math with a pro before switching ever. Don't overlook the qualified business income deduction. Many pass-through businesses can deduct up to 20% of qualified profit, subject to taxable income limits, wage and property tests, and specified service trade rules. Planning matters. Retirement contributions, health insurance, and timing of expenses can shape your QBI and your overall taxable income. Track each business separately if you have multiple gigs. When in doubt, model scenarios before year end to see whether deferring or accelerating income helps. Your best audit defense is excellent bookkeeping. Open a dedicated business checking account and, if needed, a separate credit card. Use a bookkeeping app that links to your bank, categorizes expenses, and stores digital receipts. Snap pictures of invoices, mileage logs, and equipment purchases right away. Keep contemporaneous notes on client meetings and business purpose. Back up your data to the cloud. Clean books reduce taxes you legally owe, speed filing, and keep stress manageable. Vehicles are often your biggest deduction. You must choose in year one: standard mileage rate or actual expenses. Standard mileage simplifies things and bakes in depreciation. Actual uses business percentage of gas, insurance, repairs, lease or depreciation, and fees. Keep a mileage log with date, destination, purpose, and miles. Start and end odometer readings help. If you start with actual, you may lose flexibility later. Talk to your insurer about a business use rider for coverage. A qualifying home office can be a powerful anchor deduction. The space must be used regularly and exclusively for business. Choose the simplified method at $5 per square foot up to 300 square feet, or actual expenses based on business use percentage of rent or mortgage interest, utilities, insurance, and repairs. A valid home office can convert trips from home to client sites into deductible business miles. Document the layout with photos and a floor plan. Don't miss ordinary and necessary expenses that move the needle. Supplies, tools, equipment, software and subscriptions, professional fees, advertising, education that maintains or improves skills, a reasonable share of phone and internet, liability insurance, bank and processing fees. For bigger items, evaluate Section 179, expensing 100% or phased bonus depreciation depending on year, and the de minimis safe harbor for items under your policy threshold. Timing purchases near year-end can strategically shift your taxable income. Meals and travel are deductible when ordinary, necessary, and business-related. Meals are generally 50% deductible when you're discussing business with a client or traveling for work. Keep receipts and note who, what, when, where, and why. Travel requires a primary business purpose, with documentation for airfare, lodging, local transport, and incidentals. Mixing business and personal? Allocate carefully, and don't deduct the personal portion. Per diem rates can simplify substantiation for meals and incidental expenses. Health costs are heavy hitters. If you're self-employed and not eligible for an employer plan, you can deduct health, dental, and qualified long-term care premiums above the line, limited to your net profit. Pair that with a health savings account when you use a high-deductible health plan. Contributions are deductible, growth is tax-deferred, and qualified withdrawals are tax-free. Fund HSAs, invest the balance, and keep receipts so you can reimburse yourself years later if needed. Retirement plans cut taxes while building wealth. A SEP IRA allows employer contributions up to 20% of net earnings from self-employment, with high limits and late funding flexibility until the filing deadline, including extensions. A solo 401k combines employee deferrals with employer profit sharing, enabling greater savings at lower profit levels, and Roth options. A simple IRA is lightweight but lower. Choose based on income, team size, and admin appetite. Coordinate with QBI and estimated taxes. When you hire contractors, collect a W-9 before paying, track totals, and issue Form 1099 NEC when required. For employees, set up payroll, withhold and remit taxes, and obtain workers' comp where applicable. Family strategies can work. Pay a spouse or child for real, necessary work at reasonable market rates. In a sole proprietorship, wages to your child under 18 are exempt from FICA and FUTA if structured correctly. Document duties, time, and payments with receipts. Sales tax and local rules can surprise you. Marketplace facilitator laws often make platforms like Etsy or Amazon responsible for collecting and remitting sales tax, but you still need to keep records and may owe income tax everywhere you sell. Some cities impose earnings or gross receipts taxes. Delivering or performing services in multiple states can trigger filing obligations. Track where you work, days present, and sales by jurisdiction. When uncertain, consult a pro early. Case Study 1. A rideshare and delivery driver earning $48,000 in fares and tips. With a tight mileage log of 22,000 business miles at the standard rate, plus parking and tolls, the vehicle deduction dwarfs other costs. Add a reasonable smartphone and internet allocation, a commercial use rider on auto insurance, and supplies like water and phone mounts. They set aside 30% of net profit weekly and made estimates. Result: lower tax, clean books, no penalty. Case Study 2. A graphic designer and video editor with $120,000 in revenue. They established a home office, allowing business miles from home to client shoots. Equipment and software were expensed under Section 179 and the de minimis rule. Mid-year, they opened a solo 401k, deferring employee contributions and adding profit sharing to maximize deductions. We modeled QBI, adjusted year-end billing to manage taxable income, and lined up estimates. Outcome: cash flow and reduced liability. Case Study 3. An online seller using a marketplace and a standalone shop. They tracked inventory with first in, first out, reconciled monthly payouts to 1099K totals, and booked platform fees correctly. Marketplace sales tax was handled by the facilitator, while their own shop collected based on Nexus thresholds. They used the de minimis safe harbor to expense low-cost equipment and sealed the year with a pre-close inventory count. Clean books meant faster filing and fewer notices. Before December ends, run a projection. Consider accelerating expenses or deferring income, verify vendor W-9s, review basis for asset purchases, and confirm estimated taxes. Avoid pitfalls, commingling funds, ignoring estimates, weak mileage logs, missing 1099s, and waiting until March to seek help. When to call a pro, entity choices, multi-state complexity, QBI modeling, retirement setup, or any IRS notice. I'm David Robson. Thanks for listening to Tax Smarts Unlocked. Smarter planning, smaller taxes, better sleep tonight.
Thank you for joining us on Tax Smarts Unlocked, the ultimate podcast for individuals and small business owners ready to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services. Each episode has been carefully crafted to provide you with insightful advice on proactive tax planning. By adopting a smarter tax approach, you can focus on what you do best, growing your wealth and your business. We're here to guide you every step of the way. Don't miss an episode. Subscribe to Tax Smarts Unlocked on your favorite podcast platform and unlock the secrets to confident tax planning. Remember, it's time to take control of your taxes and unleash your full financial potential.